Hello everyone, this is Dr. Ramya, and the concept that we are going to discuss is dissolution of a partnership firm. Usually any business comes into existence with a common objective, and this partnership also comes into existence with the objective of running a business formed by group of persons, more than two persons, and they contribute their capital and they run the business, and if there is any profit or loss, that has been shared by the partners who are the members of the business. So when the procedure of partnership goes fine and the objectives is met, or the time period for which the partnership firm is formed comes to an end, the partners will try to dissolve the firm, that is, try to close the business. So in that case, the business comes to an end and the partners will take up what is left out in the business, and that is the winding of the business. That will come make the partnership firm to come to an end. So this is called usually dissolution, and now we are going to see about the meaning, type, procedures, and the accounting methods involved in the partnership firm. This is usually guided by the legal framework of Partnership Act of 1932, and there are some procedures that should be adopted and methods to be taken up in case of any liquidation or the dissolution of the firm. So the commonly discussed methods are Garner versus Murray rule, proportionate capital method, and maximum loss method with regard to this dissolution of partnership firm. So we'll try to understand what is partnership. Partnership is usually the complete termination of the firm. All the activities will be closed, the business is wound up, and the partners will try to take up what is left over after the payment to the external liabilities. The partnership entity is completely closed. So this is actually the final stage in the running of the business of a firm, and thus it needs careful accounting procedures and settlement of the amount with regard to the parties involved in the business. So the common procedure is the assets will be sold and the amount realized will be used to settle the external liabilities and also the internal liabilities of business. So this is the common framework with regard to Partnership Act of 1932, and there are some provisions which have to be taken into consideration in case there is any dissolution. So the commonly happening event with regard to dissolution is the business would become sometimes illegal, or the partners become incapable, or there's any breach of agreement that is entered in the firm, that is during the formation among the partners, and that has been violated, and the time period for which the partnership is framed comes to an end. So with all these cases that occurs, the partnership will come to an end. So this has been discussed in the Partnership Act of 1932. Under these circumstances, the partnership will come to an end. The first one is the business is becoming illegal, or any of the partner becoming incapable, or there is any breach of agreement among the partners under which the partnership is framed, or the expiry of the time period for which the partnership is framed. So all these are being the common causes or the common reasons for which the procedure of dissolution will be undertaken under the stated under the Partnership Act of 1932. So with regard to the dissolution of procedure, the first step is there will be a decision to finally close the business. So once the decision has been finalized, the assets are being realized, all the assets will be sold, and cash that has been realized from the sale of assets will be used to settle the external liabilities and also the internal liabilities. The usual procedure is all outsiders will be paid first, and whatever that has been left after the payment of the outsiders will be shared among the partners in the profit sharing ratio, which has been agreed at the time of formation of the company. Usually, the partnership profit sharing ratio is being agreed between the partners, and if there's no agreement, they will usually go on the equal ratio. Sometimes they are also agree to share profits on the capital ratio. So whatever may be the case, the settlement after paying the external liabilities will be made on the ratio agreed, and the partners try to take up the loss even when the business is coming to an end. So that has also been shared by the partners in the profit sharing ratio. So before going to this particular Gardner versus Murray rule, we have to understand one concept, like in case of dissolution of the firm, the assets realized, if it is not sufficient to pay the liabilities, and the partners take up some responsibility with regard to the payment of the liabilities. So in that case, they'll try to contribute towards the firm. So they bring in the cash that is to be taken up as loss by the partners. Sometimes, even after paying the liabilities, if there is not sufficient fund to meet out all the requirements of capital, even in that case, we have to consider that partners have to suffer some loss. They are not getting back their entire capital that has been invested in the firm. So, in that case, also they have to face a loss. So, there are the usual dissolution forms, like one partner is becoming insolvent, or two or more partners becoming insolvent, or all the entire firm is coming to an end. So these are the common cases. So this particular rule, Gardner versus Murray, is applied when one of the partners is becoming insolvent. So in that case, there are two conditions to be applied. So the revaluation or the realization account is being prepared, in which all the assets will be entered and all the liabilities will be accounted into it. So the assets are being put on the debit side and all the liabilities are being put on the credit side, and the cash realized from these sale of assets will be taken into consideration to make the payment of the creditors or the other liabilities. So in the closure of this particular realization account, there may be profit or loss. So in the case there is any loss that is usually seen in the realization account, and if one of the partner is becoming insolvent, we apply this Gardner versus Murray rule, where the loss of the insolvent partners will be borne by the partners, other remaining solvent partners in the capital ratio. So this is the first condition, right? The loss of the insolvent partners will be borne by the solvent partners in the capital ratio. The second condition is the insolvent partners share of loss, as already stated, will be borne by the remaining solvent partners, and the solvent partners loss will be brought in as cash into the firm to meet out all the liabilities. So these are the two conditions. First condition is insolvent partners share of loss will be brought in by the shared by the other partners in the capital ratio, and the solvent partner's loss will be brought in as cash into the firm. So this is the usual procedure with regard to Gardner versus Murray rule. And this is again the other important or popular method with regard to dissolution of the firm. So this proportionate capital method and the maximum loss method is usually applied when there is total dissolution of the firm. It may be by order of court of law, or the mutual agreement among the partners, or any voluntary closure, or mandatory by law. In any case, there is a dissolution of the entire partnership firm. There are two methods that can be applied to share the losses that has been to be made by the partners in case of realization of assets. So the two commonly applied methods are proportionate capital method or maximum loss method. So the first case deals with the capital contribution of the partners. It focuses on what capital is being put in by the partners into the firm or the business. Usually partners will try to involve, that is given to the capital equally among all of them. But sometimes it may also happen there may be fluctuations in the capital contributed by the partners. That is, there may be differences in the proportion of capital contributed by the partners. So in that case, the loss will be borne by the partner who has contributed less. So the partner whose contribution is more should be paid first. So for this, we have to find out the proportion of capital contribution, so which will give us the excess of capital contributed by the partner. So we usually calculate taking the base of the partner who has contributed less. So for example, 10,000 is the capital contribution by partner C, and both A and B has contributed 40,000 each. So in that case, for this, and if the partners are sharing profits on equal basis, for one part, this particular C has contributed 10,000. So in that case, the other partners should have contributed 10,000, but they are maintaining a capital of 40,000. So both are going to get this excess of 30,000 what they have contributed in the form of settlement prior to the settlement of C. So both A and B should be given 30,000 each before giving any of the amount recovered to C. So these partners A and B are paid first. So whatever may be the realization, after paying the external liabilities, if there is any surplus, that surplus will be distributed among the partners who have contributed surplus. In this case, what we have discussed, A and B should be given 30,000 each, whatever be the realization, even if it occurs in installment. The first realization, if it is 10,000, 5,000 each, and if it is second realization, if it is 40,000, 20,000 each, until it reaches 30,000. So both will get their entire excess capital of 30,000. So once this is settled, whatever surplus that has been received in the final installment might be, say for example, 30,000. That 30,000 will be distributed among all the three partners as 10,000, 10,000, and 10,000. So this will be the final settlement. If there is any deficiency, that will also be borne by the partners in the capital loss ratio. So this is usual procedure with regard to the proportionate capital method. So we also have this maximum loss method, under which the amount available for distribution is compared with the amount to be settled for distribution. So this excess amount that is faced or found as loss will be considered as loss for the partners, and that will be distributed among the partners in their partner profit sharing ratio. So this does not require the tabulation of the proportionate capital, but here we just assume that the external liabilities are paid, and if any surplus that is remained, that will be paid to the partners equally, if it is sufficient enough to pay their capital. But if it is not enough to pay their capital, the deficiency will be identified, and that deficiency will be first distributed among the partners, and their any surplus after this allocation of deficiency will be found out, and that will be settled first. Say for example, here the amount realized is 40,000, and the amount required to settle the capital is some 60,000. So there is a deficit of 20,000, which will be shared among the partners in the profit sharing ratio initially. So this loss is given to all the partners, and this loss will be deducted from the existing capital of the partners, and that will be paid first. That will be the amount that will be settled among the partners. So this method, both proportionate capital method and maximum loss method, helps us to distribute the capital surplus after paying the external liabilities in a proportionate method, and that is really a legal procedure of settling the amount without any controversies. So usual procedure for insolvency of one partner is applying Garner versus Murray rule, and the total distribution of the firm is carried out under the accounting procedure of either proportionate capital method or maximum loss method. So with this, we come to the conclusion with regard to dissolution of the firm. Hope it is clear, and thank you for your patient listening. Thank you.